What is the CBOE volatility index? Well, it's the VIX, the VIX, which is the ticker symbol for the Chicago Board Options Exchange Volatility Index, which shows the market's expectation of 30-day volatility. It's constructed using the implied volatilities of a wide range of S&P 500 index options. This volatility is meant to be forward-looking, is calculated from both puts and calls, and is widely used as a measure of market risk, often referred to as the investor's fear gauge. And if you go by the old mantra, when the VIX is high, it's time to buy. And when the VIX is low, it's time to go. But that mantra may change if Morgan Stanley is correct. And that mantra would now be, it's time to buckle up. So let's take a look. First up, we'll take a look at this 100-year chart on the VIX going all the way back to 1928. So really, as it's not 100 years, it's maybe 90. But looking at the VIX chart here, you can see that whenever the VIX spiked, there was an event in the economy. Now, I can't say that the VIX is the cause of any of these events. However, if you take a look, it's easy to come to the conclusion that the VIX is an immediate reflection of problems in the economy. Going all the way back to 1928, 29, you can see this spike here in the VIX, which coincided with the Great Depression. Moving forward, we here find World War II begins, post-war inventory crisis, the start of the Cold War, Eisenhower recession, John F. Kennedy assassination, Vietnam War. Moving here to the Iran oil cut, the Volcker monetary tightening, Black Monday 1987, invasion of Kuwait, the Asian financial crisis, long-term capital management, and the Russian currency crisis, the tech bubble in 2000, the great financial crisis in 2008, and then moving here to the current time frame in the very far right, we find this spike here, which was the downdraft in the stock market in early 2018, which was late January, early February. So let's go to the next chart. And this chart here, which is the U.S. Treasury 10s, 2s spread, it's the yield curve. And again, the yield curve is the difference between the yield of the 10-year versus the yield of the 2-year. And as you can see, that difference is flattening. Now, once it gets to this red line here, it is possible that the curve will actually invert. If it inverts, and actually once it starts to flatten, that is an indication of problems in the economy. That's why it's important. And the yield curve, the flattening of the yield curve or potential inversion of the yield curve, and the VIX are two very important indications of the economy and the stock market. Oftentimes, they will point to problems in the economy and hence a potential problem in the stock market. They're two of the most reliable indications. That's why we watch these real closely. And right now, you can see that the yield curve is flattening. It's not inverted yet, but it's declining quite rapidly here. And if you were paying attention to early in the week, say on Monday this week, the 10-year yield is approaching 3%. And as I'll discuss in later videos, once we get to that 3% yield on the 10-year, that can cause problems in the economy simply because there's so much debt, either corporate debt, personal debt, or government debt tied to all sorts of things, mortgages, car loans, student and credit card debt. An increase in the yield on the 10-year is tied to so many of those things that if it continues higher, then it's going to cause some real problems in the market. So what we find is that a lot of these indications are beginning to converge at these indication points, these red lines that are signaling problems in the economy. So what we're going to talk about today is the yield curve as well as the VIX and their interesting relationship. So let's go to that chart now. So this chart here is from Bloomberg and Morgan Stanley, and as you can see, it's dated October 31st, 2017, which is when I first read about this particular relationship. And according to Morgan Stanley, they've studied this, and as you take a look at the chart there, there's a curious relationship between volatility and the shape of the yield curve. And he hadn't seen this before at all. And looking at the chart, you can see that the 2s, 10s, the yield curve tends to lead the VIX by up to 2.5 years. And you'll also notice since about 2016 that relationship between the two sort of broke down. But the relationship did go all the way back to say about 1990, perhaps even before that. Now, the breakdown of the relationship was probably exacerbated by all the different products that came out, the different retail products that came out that were selling volatility, or vol, V-O-L. You'll read about it and it'll say sell vol or buy vol. That just means volatility. And you can see that back then that relationship was broken. But let's bring that chart up to the current date. So this is a more current chart on the 2s, 10s, and the VIX. And I forgot to mention in the previous chart, as well as this chart here and the next one coming up, that the 2s and 10s have been inverted. So the flattening of the curve is actually moving in an opposite direction, because here's the zero line up here, so it's inverted. So don't get too confused on that. The inversion, the flattening curve is heading up, and the inversion, if it happens, is above this zero line here, as opposed to that very first chart or so that I showed you about the yield curve. Actually, it was the second chart I showed you. But again, the flattening of the yield curve is inverted. But the VIX is in proper orientation here. So the VIX spikes, such as in this point here, where the flattening of the yield curve, an actual inversion, happened in 2006 and 2007 or so. And then it came to this point here, and the VIX calmed down, the separation or the break in the relationship here as the yield curve began to flatten since, say, around 2015 or so. But volatility declined to this part here. And then, now let's go to this next chart, and we can see what's happened since then is that as the yield curve continued to flatten here, as we've discussed, all of a sudden volatility popped, and that relationship seems to be coming together. And so what Morgan Stanley is saying is that if that's true, then given that the flattening of the yield curve has continued, then we expect or should expect some more volatility. So they're saying buckle up for some volatility coming. Let's go to another chart to show you that I think that's going to happen. And as this chart shows here, information from Goldman Sachs indicates that last week, $393 million of inflows into short-term VIX ETNs occurred last week. At this point here, you can see, and that's the most amount of money that has come into these volatility ETNs since way back in early 2013. So the expectation is higher volatility, and in my opinion, that's exactly what we're going to get. Let me go to the last chart. And this is the VIX chart here. with stockcharts.com, and it goes back to late 2015, so it's about 2.5 years or so, and it's on a weekly basis. And as you can see here, that the VIX is calming down here. It's moving down into this level here. Now, looking at the MACD, we can see that the fast line is above the slow line or trigger line here, and then it moved down, not real sharply, but it moved down right through the trigger line and is heading down. And that is similar to what this looks like way back here in early 2016 with the fast line moving through here. So my expectation is for the fast line to continue moving down into this area here. That in turn will cause, or I shouldn't say cause, but I would expect the stock market to rise here in the short term, and then we'll see where this fast line starts to bottom out. My expectation is it's going to start bottoming out above zero. If we're going to have some volatility, that's what'll happen. But that's going to take a few weeks, if not a little bit longer, and we'll watch that. So for today, that's ChewDog Charts. Thank you.